Good evening, everyone. Thank you for joining us tonight. For some, you might have just gotten home from work and getting dinner started, or for some of you out on the West Coast, you might be still at work closing out your day. So regardless of your situation, you could be doing many things right now. And so we're very appreciative of your time and for being with us tonight. So my name is Christine Shu. I am co-founder and COO of Noblivest, and I'm here today with my partner, Margaret Kozlark, who is also co-founder and CEO. And we're extremely excited for this opportunity, which we feel like is in line with our strategy at Noblivest. This opportunity allows you to diversify your investment across three very strong assets and three very hot markets. And we really feel like diversification is key in helping you hedge your risks, especially as we chart the unknown territory ahead with a lot of concerns around sky-high inflation and rising interest rates. So today in this webinar, we will cover this deal and our team a little bit more into each of these markets and assets, and we will finish with why we personally love this deal. And this will be a condensed version of the summary. And if you want to see this opportunity in greater detail, we have a lengthy 75-slide investment summary in our investor portal. And we will definitely point you to that location in an upcoming email so that you can check out all the information around this opportunity. So at any point, if you have any questions during this webinar, please don't hesitate to use the Q&A feature. You can go ahead and type in your question if you have any, and we'll address them at the very end. So with that, I'm going to move on forward with any deal that we offer in this webinar or any future webinars. We do have to give a disclaimer. And basically, we do want to remind everyone that this is a 506c offering, which is for accredited investors only. And everything presented in this webinar is for informational purposes only, not intended to be a solicitation or offering of securities of any kind. The returns projected and presented here are not guaranteed. They could be higher or lower, and really just depends on many factors in the market, but we are very conservative with our projections. And we urge you to do your own due diligence, either through the professional guidance of a financial professional or through your own research. So the Eagle Rock Diversification Fund is a collection of 3 Class A and B multifamily assets in Tucson, Arizona, Houston, Texas, and Raleigh, North Carolina, with a projected hold of 5 years. And these are really hot markets, not just temperature hot in the Sunbelt region. It's hot because we're seeing a ton of growth in these markets. And we'll talk a little bit more about that as we go deeper into the presentation. And for this investment, our starting investment is at $50,000 or above. And we'll go into more detail. Margaret will cover off each of the assets and kind of deep dive a little bit later. So for each of our assets here, they have very unique business plans, and together they complement one another really well. They're all different, and that's what we really love about it, and especially as a diversification play. So here's a quick overview. Each of the properties are between around 200 to 350 units. So these are pretty large assets. And again, as mentioned, Margaret will go into more detail for each of them. Oh, I went the wrong way. Okay, so this is our fund management team. And anytime we do have a large endeavor like this, we have to have a very solid team. And so we've partnered with several other industry experts to create a very solid management team. And these are just some of our a few of our very fabulous team members. And another thing we're really excited about is the key sponsors for this fund is GOODECG Investments. Some of you might have heard of them. They are the fastest growing, or one of the fastest growing real estate private equity firms in this country. Annie Dickerson is this year, she was awarded the Real Estate Investor Award of 2022 by the Motley Fool. And they are also personal mentors of us. So we have personal relationships with them. They've been doing this for roughly 6 years and have had massive success through the years. And yeah, really, really excited to be partnering with them. And let's, not just, we have all the wonderful things to say about them, but, let's let the numbers do the talking. This is their portfolio over the past 5 or 6 years. They have over 8,000 units and a portfolio of over $1 billion. And their track record is amazing. We've seen an average IRR of about 22% and an average annual return of around 25% with an equity multiplier based on a 5-year typical hold time, some are shorter, of around 2.83 times. And they've had 12 successful exits since then. All right, so moving on, this is our projected investor returns for this specific opportunity. These are very conservative projections that we are showing. So again, it's not guaranteed. We're looking at around 1.87 to 2.1 times equity multiplier with a 7% preferred return. Annualized, we're around 17 to 19%. And then with the fund, we are looking at an 80-20 split. So 80% to our limited partners and 20% to our fund managers. And then our minimum investment is $50,000 and our IRR is projected to be around 15%. And I do want to add that we are so optimistic about this deal that anything above a 2 times equity multiplier, we are splitting the profit returns 50-50 with the fund managers. All right, so this is going to be around a $50 million fund, and we're targeting a raise of around $5 million. So here we have an example of what the returns might look like for a $100,000 investor coming in. From a cash flow standpoint, we're looking at 7% preferred return. And you'll see that equates to around $35,000. And on the upside, we're splitting that 80-20. So that's around $52,000 to the limited partners with a total ROI of roughly $87,000. And then also cumulatively with your initial investment, you'll return back $187,000. So in full transparency, we actually just got all of our loan terms locked in. And we're really excited about that because we have fixed rate debt, especially in the increasing interest rate environment. We've got it locked and loaded, so we're ready to go. And with our due diligence, we kind of have seen new numbers come through. And I just spoke with our underwriter today at the asset level. It looks like our cash flow projections may be a little bit higher than what we were anticipating. So really, really excited for that. But we'll definitely issue more information as they become finalized in the coming week or so. All right, so another really great bonus is accelerated depreciation called bonus depreciation. We do this through cost segregation exercise. For those who are looking for tax benefits, this is amazing because we're estimating about a 60 to 80% paper loss. Some of our newest numbers are kind of pushing more towards the 80%. And it's amazing because this year, I just want to remind everyone, this year, 2022 is actually the last year that we can take advantage of this benefit before it starts to phase out. So next year, 2023, you'll only be able to obtain about 80%. And then after that, 60% and so on and so forth. So what does this mean? If you were to invest $100,000 in the Eagle Rock Diversification Fund, you would expect to realize a year one paper loss of approximately $60,000 to $80,000. If you have any questions about cost segregation or bonus depreciation, we would be happy to have another conversation offline about it. So here's a little bit more about our fund structure. At a 7% cash flow, so 100% of that, up to 7%, will be paid to the limited partners, and everything after that will be split 80-20, as well as capital events. So if we either have a refinance or if we sell any assets, that the profits from those capital events will be shared 80-20, 80% to the limited partners and 20% to the fund managers. And also, I do want to mention, because there is a lot of management when it comes to funds, there are some fees, and we want to be fully transparent about it. However, the great thing is that these fees are already baked into our numbers, so you're not paying anything extra. If you're making an investment, the returns that you see already have the fees incorporated. So it's not anything on top of that. So as a fund management fee, we're looking at a 0.5%. And then a due diligence fee is a 1.5%, and we don't anticipate fund expenses to be anything more than $25,000 annually. So we do We will issue your distributions and also your K1s every year, as well as certain filings that have to occur from a state and national level. So that is part of those fees. And with that, I'm going to turn over to my partner, Margaret, and she's going to walk through and deep dive into each of the assets. So I'm going to give the mouse control over as well.
Awesome. Thanks so much, Christine. And thanks everybody for being here tonight. So let's get into some of the specifics about the each individual asset. So we're going to start here with Mission Antigua, which is our asset here in Tucson, Arizona. And I don't know. Oh, it's clicking for me. Oh, there we go. Okay, so this is a great asset, among other things, because the location is terrific. It is less than 15 minutes from downtown Tucson, and it has close proximities to many of the major employers in the area, including Raytheon, the Tucson Airport, the Air Force Base, as well as the University of Arizona. It is a Class B asset, and it's a mix of 1 and 2 bedroom units with some modern amenities like a fitness center and a pool. And the really exciting thing about this asset is that 75% of the units have already been renovated and are achieving a rent premium. So basically 75% of them are already showing that our business plan works. And part of our plan is going to be to get the other 25% renovated and up to speed. In terms of just a little bit of the more details about it, there's a total of 248 units. It was built in 1989. Currently, the average rents are $1,055, and that is actually $290 under the market rate for this area. So as you can see, there's a big upside in getting these rents up to market value. I did mention that about 25% of that is going to be a value add. So in addition to the interior unit renovations, we are also doing some CapEx on exterior issues. Things like replacing some of the older roofing. We're going to install new security, update the lighting, repave and refresh the parking lot. And then we're adding some other fun things like a dog park and an updated barbecue area and some landscaping and just some things really to make it more pleasing and pleasant complex to live in. With each of these properties, as I review them, I really like to highlight the asset management team of each individual property. Now, for this particular one, Gary Lipsky, who is the CEO of the Break of Day Capital, is going to be handling the asset management, and Scotia Group will be doing the property management. And so Gary is the boots on the ground. And in addition to being a well-established asset manager with over $98 million in assets under management. He is also the host of the Real Estate Asset Management podcast and a founder of the Asset Management Summit. So he definitely knows what he's doing in terms of asset management. And in addition, Scotia Management Group, this is the group that actually led and oversaw the renovations on those 75% of the units. So they're going to continue working on them with the remaining 25% of the units. So now let's talk about the Sarah at Lake Houston. Okay, I'm just going to sit here for a minute and let you look at these pictures because this is a gorgeous, gorgeous complex. I think I mentioned that Mission Antigua was a B+. The Sarah is an A+ asset, and it is so huge. It is in Lake Houston, which is a very affluent submarket of Houston. And Houston itself is having monumental growth. It is home to over 500 digital tech companies, and it is also the #4 city in terms of apartment demand. And the Sarah as a complex is truly amazing. It is a premier complex with exceptional amenities, including a resort style pool. There's a beer garden, a state-of-the-art fitness center, and a multi-sport simulator. So this is a really exciting asset for us to acquire. A little bit more information. It's got 350 units, as you can see, built in 2020. The average rent is about $14.87. So surprisingly, there are still some upside. There's an upside of about $113 where we can get it up to market value. And why is that? Well, a lot of times it's because developers come, we're buying this asset directly from the developer. So they do a great job of building the asset, but they don't do a great job of necessarily leasing the asset. Their job is to build it, make it look pretty, get people in, and then sell it so they can move on to their next project. So when they do the selling, they tend to do a lot of concessions. They tend to do things like first and last months free, maybe lower rent. So there's still upside opportunity for us to get those rents up to market value and par with an asset of this quality. In terms of capital expenditures here, as we mentioned, there's really little to no improvements needed in the actual units themselves. So our plan is to freshen up some of the common areas as needed, but really to focus on operational efficiencies. So we will work to burn off that loss to lease, improve the property management. We are going to minimize those move-in concessions, do a little bit of improvement with community activities, and definitely continue catering to a very professional and millennial clientele. But in addition to capital expenditures, we have quite a bit of opportunity for additional income streams. Things like private yards. Currently, about 26 of the units have private yards that they are not paying any additional for. So we will incorporate a $75 per month charge for those, which will get an additional $23,000 in income just on that alone. We will also be looking for other income streams from storages, renting garages, improving the water, sewer, internet, and amenities. But the most exciting thing, I think, is something called valet trash. And you may not have encountered this yet in some of your investments, but personally, I love this idea. And basically what it is for those of us who have lived in an apartment complex ever, when you have your trash, you take it out and you usually have to drive or walk all the way to the corner of the complex where they have those dumpsters and dump your trash. And, it could be raining, snowing, whatever the bad weather is. With valet trash, for just a small $25 a month fee, you can literally get your trash picked up just outside your door. So just doing that one thing, which for $25 is such a small amount for this great convenience, that one thing could capture $94,000 of additional income per year. So we're really excited about some of these, additional income potentials here. And the sponsorship and management team here is Zane CRE and Sunsail Capital. Zane is founded by Ike Mutabana and Dustin Howard. And I have actually personally worked with Ike and Dustin on a previous property, the Burgundy, which just went full cycle earlier this year. And that was a really interesting property because we acquired it in 2019, just before the pandemic. And in spite of COVID and an ice storm and a tornado that did some roof damage, it was so well managed and underwritten that we still managed to achieve a 40% return to our investors after just 2.5 years. So we have a really solid management team in place for this asset as well. So now let's talk about Timber Hollow. So Timber Hollow is a really nice garden style community. Again, fabulous location. It's right in the heart of the Research Triangle Park in Chapel Hill, which is a suburb of Raleigh. It is, in addition to the Research Triangle location, it's very close to UNC Chapel Hill and Duke University. And excitingly, this is a classic value add. So up to 2/3 of these units have significant upgrade potential. So of course, once we upgrade those units, then we can raise the rents, in accordance with the improvements. But even without those improvements yet, this property has achieved a rate of 10% rent growth just in 2021 alone. So once we put the improvements in them, it's definitely the stage is set to get that up to market value and get some great returns from that as well. So let's talk a little bit about this unit. There's 198 units here, built in 1987. So again, it's getting a little bit older, time for a nice refreshing. Average rent is $1,153, which is projected of $270. We will have an increase in rent premium once we get those apartments fixed up and up to market value. In terms of the CapEx here, definitely it is a heavier value add. So we're going to be allocating $8,000 per unit just for the interior renovations. But in addition, we're going to be incorporating a unit technology package. We're going to upgrade some of the water heaters and HVACs. We'll also handle some of the deferred maintenance that have been kind of put off on some issues with the complex. And then we'll just freshen up the common areas. And this sponsored management team is Mesos Capital. It's Pancham Gupta and Rajan Gupta. I actually know these two gentlemen as well. Pancham has had a very successful cash flowing business with a portfolio that cash flows in the double digits. He also was the co-founder of the multifamily mastermind New York City group, of which I am a member. And Rajan has also a successful track record of value adds and rehabbing, and he's also delivered double-digit investor returns. So really solid teams on all of these assets. So why invest in a fund versus a single asset? For those of you who are on this Zoom who may have done syndication before, it's normally traditionally maybe one asset, any one of these you might have invested in individually versus a fund that has all three. So here's some of the reasons why we think the fund is a good idea. So number one, we are living in uncertain times. Christine mentioned that we had our interest rates locked down, which is very important, but there's a lot of risk and a lot of just uncertainty of what's going to happen. So diversifying across multiple properties in multiple locations really help keeps your money stable. In terms of the asset class and the business plan, you get to have A+ and B+ properties, as well as a mix of business plans. Some of them we saw were partial value add, some were more. Others, in the case of the Sarah, really was a matter of controlling efficiencies and getting up to market value with rents. Most excitedly, in terms of working with the fund, we can offer you better access. So with many of these assets, if you were to invest directly, there might be a minimum of $100,000. Our minimum is $50,000, but also there's a lower equity split. So traditionally it's a 70-30 equity split where the investors get 70% and the management team takes 30. With our fund, we're able to have that at an 80-20, which gives our investors more cash of the returns. Of course, we still have that same pass-through tax benefits from depreciation using our cost seg strategy. We can minimize the risk and returns because it's now multiple assets versus a single asset. And in terms of our exit strategy, when you just have one property, your only option is just to sell that one property. But because we have multiple assets, at any point we could individually either sell them as a package or sell assets individually. So again, it just gives us options. And then lastly, from a convenience standpoint, you don't have to send or sign 3 separate PPMs and do 3 separate wire transfers. It's just one PPM, and then you can spread your equity across multiple assets. So Christine, let's talk about why we like this deal so much.
Yes. So we're really, really excited for this deal. Location, location, location. These are really hot markets. And as we mentioned, and it's not just the location, it's the diversification of those locations together and collectively. So also, we really like that these are Class A and B assets. They're very strong with returns around 1.87 or more. And we're looking at returns in about 3 to 5 years. So also, we do see that market rents have opportunities to increase around $100 to $300 per month. That's spread out across 200 to 350 units per asset. That's quite a bit of upside.
That adds up.
It really does. Yeah, we're talking about millions of added value there. And also with the tax savings, we have 3 assets, so you get a little bit more bonus depreciation. Most of the time when it comes to single assets, you might only have maybe 40 to 60, but because we have 3, it's kind of even more so in terms of tax savings. And also we really love this team. As mentioned earlier, these are really the best of the best in the business. With GOODECG and each of the boots on the ground sponsorship teams, across all of them, there's more than a decade years of experience when it comes to real estate and multifamily. And also there's really great experience in reputable property management companies with really strong track records that will be managing each of these assets. And in case I didn't say it enough, location, location, location. So these are really the hottest markets in the US. You can see here, these are the top 20 fastest growing US metro areas. And 2 of our markets are in the top 5, Raleigh and Houston. And collectively, they're looking at around like 17 to 20% rate growth just in the last couple of years. And this is actually data from 2020. Now we're in 2022, so we're even anticipating this is a little bit higher. Mm-hmm. And also in our Tucson market, it didn't quite make the list, but in Tucson and just Arizona in general, we've seen so much growth. And Tucson specifically, here I have a chart that shows the rent growth through the years. And this is for 2-bedroom. 1-bedroom is also tracking the very similar trajectory here. Quite a bit of increase. We're looking at a year over year, around 17 to 22% rent growth in the Tucson market. So really, it's all about growth. In the event that we do proceed to a recessionary environment, that is very market specific. We really don't feel like a recession will hit these markets just because of the demand. and the growth of population and job diversity. So with that, if you are interested in joining us in this really exciting investment, again, we want to mention that this is a 506c offering open to accredited investors only, with a starting investment at $50,000 or more. We accept various forms of funding. You can either invest your cash, or if you have self-directed retirement plans, this is a really great investment for those vehicles. And yeah, if you're interested, please do reserve your spot. It's a first come, first serve opportunity. And for this specific investment, we anticipate that distributions will start around after a full quarter. So we're anticipating October, and distributions will be quarterly after that. And so with our investment process, if you're ready to invest, here are the next steps. The offering is open for 3 weeks in May. You can go to our Noblivest investor portal and decide how much you would like to invest, and commit by reviewing and signing the subscription documents. And once you've signed, you'll receive funding instructions. And then after that, you'll have to verify your accreditation status. So in the portal directly, you'll have access to a third-party verification service. You can either go through that, it is a free service for you, or if you have a letter from your CPA, attorney, or financial advisor, you can use that. Just have them draft a letterhead, and you can submit that directly into our portal. And then after that, step 4 is to send in your funds to secure your spot in the deal. Please note, for this particular investment, we only accept wires. And then lastly, our fund closes the 3rd week of May. We're shooting for the 24th, and we'll send you updates regularly after that. So our first asset is scheduled to close the last week of May. That's the Tucson property. And then several weeks after that in June and possibly into July, we'll be closing the next 2, the Sarah and the Timber Hollow. So with that, that concludes our presentation, and we would be happy to open up to any questions.
And while we are waiting for questions, I do want to elaborate a bit more on something Christine said about location. You know, when we look for locations in which to recommend investments, we often look at Sunbelt areas, but we also rather look at areas that have not only population growth, but job growth and job diversification. So we will look for jobs in the tech sector, or the more kind of white collar sort of high end type things that tend to be a bit more recession resistant than some of the areas that were struggled a little bit during the last recession. And that's why population growth is so strong. One of them, I think it was Raleigh, had a population growth of almost 20% just in 2 years when it was in 2020. So that's just something to consider as you're looking at this. Okay, great. You know what I'm thinking, Christine? Maybe what we should do is we can close it up. And if any of you have any questions, or if you'd like to reach out to us and schedule a private phone call to discuss this in detail, we are happy to do that. Again, it's Margaret@noblivest.com or Christine@noblivest.com. And we can send you the larger PPM if you'd like to dig deep and go crazy with all of the numbers, or answer any questions you may have about this specific asset. Unless, Christine, you've got some questions on your end that you're seeing.
Yep, no questions coming in. I do want to mention we have been receiving questions in the past about rising interest rates and the loan for these 3 properties. I did mention earlier in the presentation that we just recently got the loan locked in. We're using a combination of various loans, and each of them have rate locks that prevent the rates from going up above a certain amount. So collectively, on average, I think the highest rate that it could go is around a 5.5% interest rate. And all of these loans throughout the entire 5-year period are interest only. So we don't have to pay principal on it, which is really great for us, because that means it's higher cash flow back to our investors. So we're really thrilled about that, especially in the increasing interest rate environment that we are in. We know that there's a lot of anxiety around it. So our rates, have caps, and we are fully prepared for that. So we feel like this investment is extremely safe because of that. And we feel really optimistic for each of these 3 properties.
And just to add to that, Christine mentioned there's a lot of anxiety right now. There's a lot of uncertainty between inflation and the rising interest rates and even the war in Ukraine. And we're seeing the effects in the stock market. And that's why it's really important to diversify your portfolio. And that's why this tends to be more of a lower mitigated risk when it comes to the 5-year hold, things like the rate caps. It's a better way to stabilize those risks and really preserve and still grow your capital over the next 5 years. So that's why we feel very encouraged about this, even with everything that's going on right now.
Yes, that's right.
Mhm.
All right, so I don't see any other questions coming in. So we can go ahead and conclude this presentation. And if there's any additional questions, as Margaret mentioned, please don't hesitate to reach out directly to us.
Thanks everyone for joining us.
Thank you. Have a great night.
Bye-bye.
Bye.